Hello viewers, welcome to the Proven Trading Setups. Myself Brijesh Bhatia. In the last video, we discussed about volume and volume spread analysis, which plays a key role in identifying the trend. In identifying the participation happening at certain levels of breakout or pullbacks, when to enter using volumes. Well, we'll go one step ahead into this volume spread analysis in today's video. And I will show you how fund manager use this technique to spot the winning trades or the winning stocks. This is very much important even for fund managers and for retailers. Well, fund managers look at the volume action what retailers are doing. Retailers look at what the volume action fund manager are doing. And this technique is quite long, which I'll be discussing. And it's been historically proven to be a successful trading for fund managers, for smart investors, for retail traders. What is all about? So if you look at the first, I have shown some accumulation process or market phases. So market phase goes in a three phase manner. First, it starts an accumulation phases when the stock is at the niche level, or I would say the lowest level of its historic moves. The stock is not known to someone into the retail space. There is no buzz about this stock. No one have heard about the name. Also, it might happen that sometimes it might happen that the stock has a big brand name. Listing has happened. Stock has done nothing. Slow and steady accumulations happens by smart investors, by FIIs, by DIIs, but still retailers don't get attracted to it. And the slow and steady accumulations happen in probably the months, years where stock is consolidating. Smart investors accumulate in a phase manner where retail investors get tired, and I'll show you how they accumulate, in what phases, and how you should read it. Second, it gives a breakout markup stages there. Again, it goes into reaccumulation phases for months and years. It breaks out, distributions happen, and generally the smart investor which has bought at the accumulation phases, stocks goes 10x, 20x, 30x, 40x, 50x, 100x, and then the stock is being sold out. That's the market phase, and this phase was defined by Mr. Richard Wyckoff. So just to throw some seconds on him, he was one of the finest writer in Wall Street Journal. And in the benefit that most of the smart investor accumulate and retailers don't know which stock they are accumulating, at that point of time when data was not that available, he used to write in Wall Street Journal and circulate that weekly magazines. So coming on to the accumulation phases. So first I'll be defining here the Wyckoff accumulation theory. So what is this? The stocks goes down, which is known as preliminary selling. The volumes are slow and steady, but the stocks is going down. No one is interested in buying the stock. Then there is a huge sell-off coming into that, which is known as selling climax over here. And that would be the biggest bearish volume of all the preliminary selling to selling climax. Then stocks goes into consolidation. There is a pullback then, and most of the retailers, most of the traders think that the bottom has formed and stock is now about to reverse, and that's the biggest trap which happen. So when you find a selling climax volume, as I said, when, if you remember our previous video where we have defined volume analysis, the pullbacks are with lower volumes, and again there is a bigger volume. So generally the bull trends and bear trends end with maximum volumes. And we have, in the previous video, if we haven't watched that volume analysis, do watch that video, and we have discussed Infosys as well. it gone up, we have witnessed a huge selling pressure, then stocks went into consolidation. So that bullish momentum ended over there. Similarly, over here, the bearish momentum ends when the biggest selling climax volumes happen. Stocks goes into consolidation, stocks retest those zones. There is no volumes picking up in this phase. And slow and steady accumulations happen by these FIIs, DIIs, fund managers, smart investors, because generally these accumulation phases take years to come, months to come, and then the stocks break out. But how do you know that the stock will be breaking out? So there is a spring. If you look at the chart, there is a spring at the lowest level of this accumulation, of this channel, you can say. And that breakdown fails. How do you know that breakdown has failed? The breakdown to the recovery, the V-shaped momentum from the, I repeat, from the breakdown, it goes down and the V-shaped recovery happens. And that's the called shakeout or spring, we say. And that V-shaped recovery should have a huge volume bar. Remember that. That V-shaped recovery, I'll come on to example which will explain you. And that V-shaped recovery should have good volumes, which is very, very much important. And when the volumes confirms that the bottoms is been made, what happened with the retailers? Retailers have bought some stock, they get frustrated, stocks break down, and people come to exit the trades. And that's the lowest level people retailers exit, and fund managers buys at those levels because they can get the maximum volumes at the lowest level. So for example, the range of 100 was accumulating and price broke out suddenly at 93 rupees, and you have bought at 110. So you think that okay, 100 is the lowest level, if that breaks I'll exit out. So most of the retail investors exited 98, 99, 97, 96, 95, and the maximum what fund manager can accumulate is those levels, the lowest level, and automatically his averages come down. So that's the most important spring part you have to identify, and fund managers identify those spring where the retails are exiting out, and they buy the maximum quantity they can, and the bottom of the stock is formed. And this bottom will be formed for months and years to come. I'll show some examples to you. Then there is a phase which generally after the spring it removes the highs are broken, which is phase D and E, and the stocks goes higher and higher. And generally the phase D and E are basically E are the fastest rally you can see in the V-shaped recovery. So let's look at some of the examples over here. So this is the Bank of India example. This is again the older chart. Look at the preliminary selling climax happened, and look at the spring. The volumes here was picking up in the V-shaped recovery, and then we have seen stock right from around 80, 82 to around 115 in quick time. Then it went on to around 130 as well. So which was more than 50% gain. Tech Mahindra, a huge accumulation took place, and this is again a weekly chart. If you look at after the preliminary selling climax, we saw a spring, and look at that V-shaped recovery. It happened from the around 350 stocks went directly to around 800 plus levels. So again, Tech Mahindra, the elephant, is been doubled in a time. So remember, these Wyckoff theory, the fund managers play a key role, and they accumulate when the retailers are exiting out, and they know with the volumes that how they are exiting out. And this theory you can also apply in your trading investing system, which will really help you out. So as usual, let's come to the strength weakness. What are the strength of and weakness? So for let's first understand strength first. Again, it is a great tool to understand how the fund managers, how the retail, how the smart investors are accumulating the stocks. How you can analyze with these volumes. Fund and as I said, fund manager analysis how the retail participant and they can gain maximum at the lowest level. The volume here indicates everything, so you need to keep a watch on volume price action. And the best part of this, I always love this theory because you don't need any oscillators. And generally, when you add the oscillators, sometimes it happens that the price action is saying something and oscillators are saying something. So no oscillators needed, which is the biggest strength I would say. On the weakness, analyzing generally take times. You need patience, how the things are spinning, and you need to keep a watch on that price actions very on a regular basis. And as I said, accumulation plays a key role, and it takes time when fund managers or FI or DIR, some of them are buying, so it will take time. So retailers generally get frustrated with this. So that's the biggest weakness you should. So, just summary, accumulation theory by Richard Wyckoff is an eye-opener analysis for long-term investors, and most of the FIIs, DAIs, or even retailers use this. I am using for nearly more than a decade now. Again, this is, as I said, this is old theory. This is not a new theory. So generally, most of the people believe that if the modern era of technology does this theory work, yes, this theory still works. Fund manager use this accumulation wisely because they know that how retailers are playing out, looking at the volumes, and it can be implemented on any asset class which has volume data. So that's the summary of Wyckoff accumulation theory. In the next video, we'll be discussing an indicator which is helping to predict a bull run. And again, Nifty is one of the classic example of these. I'll show an example, and I hope this video series is really helping you guys, traders, investors using tech analysis. I hope this theory will be an strategy which I have discussed will be a good momentum based strategy which you can implement. RSI 162, which was an investor strategy, you can implement. And again, the Wyckoff accumulation theory, which I have shown, you can implement in your analysis. Signing off, Brijesh Bhatia. Thank you.
I am delighted that you joined me to learn about my proven trading setups. If you would like to hear more from me, then sign up for the Fast Profits Daily, our free email newsletters. You can click here to sign up. Thank you.